I think $3 billion. I want to say $3 billion. There was a cryptocurrency exchange that had about the same, about $3 billion. There were a lot of companies that had hundreds of millions of dollars of deposits. The total deposits were about $140 billion at Silicon Valley Bank. Only 3% were insured.
In this interview, Jim Rickards discusses the precarious state of the banking system, highlighting recent events where a cryptocurrency exchange and various companies faced significant losses, totaling around $140 billion in deposits, with only 3% being insured. He recounts a scenario where the Federal Reserve stepped in to guarantee government bonds and all bank deposits, essentially eliminating any further tricks to calm financial panic. Rickards draws parallels to past banking crises, emphasizing how they often occur in two stages, with a quiet period in between before resurging worse than before. He points to recent developments in the banking sector, such as the rescue of New York Community Bank, as potential signs of an impending Stage 2 crisis. Rickards concludes by questioning how central banks can effectively stop bank runs given the already implemented measures.
So 97% of $140 billion was ready to go up in smoke on Friday night. By Sunday, they said, no, just kidding. They're all insured. And then the Fed said, oh, by the way, every member bank in the system, now you're talking about trillions of dollars of assets. If you have U.S. government securities, send them to us. We'll give you par value in cash. But the point is they were only worth 70 cents on the dollar because interest rates had gone from 1% to 5%. Those 5-year notes and 10-year notes on the books of the banks had lost 20 to 30% of their value. So here's the Fed saying, we'll give you 100% of the value, even though they're only worth, let's say, 80%. I had a used car at the time. I said, would you take my used car for what I paid for it? That would be great. It's not worth anything. It was 15 years old, had 250,000 miles on it, but that's what they did. And then I thought at the time, oh, gee, you just guaranteed every deposit in the banking system, and you just said every bond is worth par, no matter how far underwater it is. You're out of tricks. Like, you have no more rabbits. Once you guarantee every government bond in the system and every deposit in the system, there are no more rabbits in the hat. Now, it did the trick, which is after First Republic, things calmed down, and then Wall Street's back to, Goldilocks, pivot, soft landing, all this stuff. But my experience was that severe banking panics, either monetary banking crises or financial crises, they can be different, happen in two stages with what I call a halftime. So I'll give you a couple of real quick examples. We all remember September 1998, that was the height of the long-term capital management. Russia defaulted in August. Long-term capital management was rescued in September, but if it hadn't been rescued, they would have sequentially closed every market in the world. I mean, we saw that happening. But that started in June 1997 in Thailand, when they devalued the Thai baht and put on capital controls. And then it spreads, your neighborhood, Shay. It spread to Malaysia, Indonesia. Then there was a big blow up at the Hong Kong IMF meeting with George Soros and Dr. Mahathir, my friend, Tun Mahathir. And Bob Rubin had to come in and break up the fight. And then it spread to Korea, and there was literally blood in the streets. People were getting killed in riots, money riots in Korea. But then it calmed down. This was all from June to around September, October. But then November, December, January, February, on into early 1998, it was very calm. And everyone says, well, glad that's over. But then beginning in April, then peaking in September, it came back again. Same thing in 2007. I mean, remember, that started in, believe it was kind of March of 2007, when HSBC announced that their mortgage losses were higher than expected and earnings were disappointing, etc. And Ben Bernanke was quoted on the record saying, no problem, this will blow over. And then August 2007, Jim Cramer's famous rant on CNBC with Aaron Burnett, they know nothing, they know nothing. He was right, by the way. They didn't know anything. They never did. But then it calmed down. September, Hank Paulson had the super sieve. We're going to buy up all the credit card receivables from all the banks. It never happened, but just saying it calmed people down. And then in December, this is the funniest part. In December 2007, they called up all the sovereign wealth funds and they got them to buy 9%, between 5 and 9% of all the big banks. So Kuwait, Abu Dhabi, Government Investment Corporation of Singapore, and a few others. They went around and they bought between 5 and 9% of Morgan Stanley, Citibank, a couple other banks, and they kept offering to buy Lehman. South Korea was going to buy Lehman Brothers. The problem with Dick Fuld is they kept sending the ambulance, and he refused to get in. He didn't understand it was over. They were trying to help him, but so all the sovereign wealth funds bailed out the U.S. banks in December. So everyone goes, "Okay, that's over." Well, it wasn't over. Now it's going to 2008. So there was a quiet period. March, Bear Stearns fails. June, Freddie Mac and Fannie Mae fail. August, Congress bails out Fannie Mae and Freddie Mac. Then September 15th, Lehman Brothers. Then AIG, Morgan Stanley, Goldman Sachs were hanging by a thread. So my point is, that started in the spring of 2007. It peaked in September, October 2008. But there was a quiet period. By the way, they called the sovereign wealth funds again in September 2008, and they said, "No thanks, we've had enough fun. We're not bailing out," because all those investments were underwater at that point. So the history of crises is that they become acute, steps are taken, they calm down, everyone thinks it's over, and then they come back worse. So I look at March to May 2023 as stage one. I look at the period since then as the quiet period, as I've described it, and I just gave you two historical examples. So we're ready for stage two, and it started. There's something called NYCB, New York Community Bank. It's got $100 billion of assets, so it's in that middle tier. It's not a too big to fail giant, but they announced a couple of months ago a $2 billion write-off in commercial real estate, which we were just talking about. Then their stock cratered. There's a run on the bank. It was hanging by a thread. And then Steve Mnuchin, former Treasury Secretary of the U.S., put a syndicate together, and he raised $1 billion of cash, and they took over the bank. Now they fired management, put in their own people, took over the board of directors. The stockholders effectively got wiped out because they were diluted by the $1 billion of new money. So it was a bail. It was private sector. It wasn't the government. But that bank effectively failed and was rescued by a private syndicate with $1 billion in new cash. That's a small, I would say not small, but small to medium-sized lender on Long Island, 30 miles outside of New York City. That's the canary in the coal mine. Combine that with what I was describing about commercial real estate, monetary tightening, and what we see are the ingredients for a series of bank runs. Except going back to what I said earlier, what's the Fed going to do now? They've already taken all the government securities, and the FDIC's guaranteed all the deposits. How are you going to stop the run?